Now let's look at options. Options are derivatives. Options derive their value from an underlying security. Now there are two types of options. There's a call option and a put option. Each option has a strike price. Strike price is also known as the exercise price. That is the price that I could either exercise the option at and buy the stock for or sell the stock for. Contract size tells me how many shares of stock I can buy or sell when I exercise an option. Unless you're told otherwise, the contract size is 100 shares. Now, when I buy the option contract, the put or call, the contract has a value that is known as the premium. The value that is known as the premium. Now, premium has two parts, time value and intrinsic value. What's intrinsic value? Well, if an option is in the money, it has intrinsic value. It has intrinsic value. Now, if an option's premium is equal to the intrinsic value, that option is said to be at parity. Now, if an option is not in the money, it could either be out of the money or at the money. And we're going to look at all of this in detail. What are my strategies when it comes to options? Some option positions are bullish. Some option positions are bearish. What can I do with a call option? I can buy that option. I can go long that option. And if I do, I'm bullish. Now, the maximum gain, if I buy the option, is unlimited. The maximum loss is my premium. And the break point is strike price plus the premium. Remember, call up. We add, call up. What if I am short a call? Well, I am bearish. I'm bearish. I think the market's going to go down. The maximum gain would be the premium that I received. The maximum loss would be unlimited. And the break even would be strike price plus the premium. Puts. I could go long a put. I could buy a put. If I do, I'm bearish. Max gain is strike price minus the premium times the contract size. What's the maximum loss? I'm long the option. The most I could possibly lose is the premium. And what is the break even? Strike price minus the premium. What else could I do with a put option? I could sell the put. I could go short the put. In this case, I am bullish. In this case, I'm bullish. The maximum gain would be premium. The maximum loss would be strike price minus the premium times the contract size. The break even would be strike price minus the premium. Remember, call up, we add, put down, we subtract. Call up, we add, put down, we subtract. Let's take a look at some option transactions. Let's say we have a client who buys one ABC 35 call at 4. Well, the number of contracts here is 1. They buy one ABC 35 call at 4. They bought one contract. What is the size of that contract? If they were to exercise that option, how many shares would they be able to buy? Contract size is 100 shares. So they would be able to buy 100 shares. Now, the strike price or the exercise price is 35. So they would buy 100 shares at $35 a share. Now, this is a call option. That's the type. And the premium that they would pay, is $4. $4. Now, that's $4 times the contract size. And what was the contract size? 100 shares. So the client would pay $400 for this option. They would pay $400 for this option. Now we need to find out if this option is in the money, at the money or out of the money. Let's say that the stock price of the stock trading in the secondary market is $38 a share. Remember, call up. If the current market value of the stock is higher than the strike price, than the exercise price, this option would be in the money. This option would be in the money. Well, the current market value is $38. Strike price is $35. This option is in the money by $3. This option is in the money by $3. The amount the option is in the money is known as the intrinsic value. So the intrinsic value for this option is 3. Now, recall premium equals intrinsic plus time. Premium equals intrinsic plus time. So if the premium is 4 and the intrinsic value is 3, 4 premium minus intrinsic value is 1. So time value is 1. So intrinsic value of 3 plus time value of 1 gives me a premium of 4. The client would pay $400 to buy this one contract. Now, what if the price of the stock in the secondary market is not $38 a share, but it's $35 a share? Well, that's the same as the strike price, so this option would be at the money. This option would be at the money. What if instead the current market value of the ABC stock in the secondary market is $32 a share? Well, this is a call up in the money, call up. Stock price higher than the strike price. Here we have the stock price lower than the strike price. This option is out of the money. It's out of the money by 3, out of the money. Now, what's the maximum gain for this option? The maximum gain is unlimited. Maximum gain is unlimited. I could exercise this option, buy the stock, own the stock for $35 a share. In theory, how high could this stock go in value? There is no limit. So my gain potential is unlimited. What's my loss potential? Well, the worst thing that could happen to me is the stock value doesn't go up. It goes down or stays the same, and the option will expire. In that case, the most I could lose is my premium, $400. $400. When would I break even? When would I break even? Well, that is strike price call up plus the premium. Strike price of $35, premium is $4, break even is $39. So the stock would have to go above $39 a share before I would start making money. And that makes sense because I'm putting $4 into this option. So the stock price would have to increase enough to cover that expense. So strike price plus the premium would be break even of $39. Stock would have to go to $40 or higher before I would make money. Now, let's take a look at an example of selling an option. Selling an option. I sell one XYZ 40 call at 6. Now, selling the call is bearish. Selling the call is bearish. If buying the call is bullish, selling the call would be on the other side of the market. Selling the call would be bearish. What if the price of the stock in the secondary market is $42 a share? When is a call option in the money? Call up. Now be careful, I don't care if I'm long the option or if I'm short the option. When is a call option in the money? Call up. So the strike price is 40. Strike price is 40. The stock price is 42. This option is in the money by $2. Intrinsic value is 2. Intrinsic value is $2. This option is in the money by $2. Remember, premium is intrinsic value plus time. So if premium is 6 and intrinsic value is 2, what's time value? Well, premium 6 minus intrinsic value of 2 gives me a time value of 4. Time value of 4. Let's now talk about max gain, max loss, and break even on this short call. So I sold this call. I took in that premium of 6 or $600. That's a credit to me. The best thing that could possibly happen to me, this option expires and I get to keep the premium. So the maximum gain is $600. The worst thing that could happen to me is this option is exercised. I have to sell 100 shares at $40 per share. I don't own the stock. I would have to go in the marketplace and acquire the stock. In theory, at what price would I have to acquire the stock? Don't know. Could be any price. So my maximum loss potential is unlimited. And what is my break even? Again, call up, strike price plus the premium. I don't care that I'm short the option. Call up, strike price plus the premium. My break even is 46. I start losing money if the stock price goes above $46 a share. Now let's take a look at puts. What can I do with a put? I can buy a put, I can go long a put, or I can sell a put. I can go short a put. Let's look at a buy example first. I buy one MMLJ25 put at 2. What's the contract size? 100 shares. What's the strike price? $25. What type of option are we looking at? A put. And what's the premium? 2. Now, how much would this cost an investor? They're buying, so they would have to pay 2. Well, that 2 premium times the contract size. Contract size is 100 shares. This option would cost the investor $200. Now, they have bought the put because they're bearish. They think the price of the stock is going to fall. So we're going to try and figure out what if this option has intrinsic value or not. When would a put be in the money? Remember, intrinsic value is in the money. When would a put be in the money? Put down. When the stock price is below the strike price is when a put is in the money. So if the stock price, the current market value in the secondary market is $23 a share, that's $2 lower than the strike price. So this option would be in the money by $2, would have intrinsic value of $2. Now remember, premium equals intrinsic value plus time value. Premium equals intrinsic value plus time value. So if the premium is 2 and intrinsic value is 2, what is the time value? Well, premium of 2 minus the intrinsic value of 2 means time value is 0. This option is about to expire. This option has a premium that is at parity. Remember, parity was when the premium equals intrinsic value and there is no time value. So this option is at parity. The premium is at parity with the intrinsic value. What's the maximum gain, maximum loss, the break even? Well, maximum gain. I bought this put. I could exercise the put and sell the stock for $25 a share. Now, I'm bearish. I want the price to go down. How low could the price go? Well, the price could go to zero. So I exercise the option and I sell the stock for $25. Price has gone to zero. I buy the stock back at zero. Buy the stock back at zero. I made $25 a share. I made $2,500. But from that, I've got to subtract that premium that I paid, which was $200. So the most I could gain is $2,300. $2,300. What's the most I could lose? Well, I buy the option. I'm out that premium. The most that I could lose, the worst that could happen to me, is the stock price could stay the same or go up and the option expire worthless, and I could lose that premium of $200. What's my break even? Put down, strike price minus the premium. So break even would be 25 minus 2. 25 minus 2 would be 23. Break even is $23 a share. Now, there's a little trick you can use. If you solve for break even, you take break even times your contract size, 100 shares, and that's your maximum gain. What if the stock price in the marketplace were $25 a share? Well, that's the same as the strike price, so that option is at the money. What if it is $28 a share? That's above the strike price, that is out of the money. One more example. Let's sell one PTX 50 put at 3. I am bullish. If I bought the put making me bearish, when I sell the put, I'm on the other side of the market, I'm bullish. If the stock price is 48, put down, that's $2 lower than the strike price. This option is in the money by 2, has intrinsic value of 2. If the premium is 3, minus intrinsic value, time value is 1. What's the max gain, max loss, and break even? Well, I sold this option, so I took in $300. What would I like to happen? I would like for the stock price to go up or stay the same, the option expire, and I get to keep $300. So the most I could gain is $300. The most I could lose is break even times the contract size. What's break even? Strike price minus the premium, 50 minus 3. Break even is $47. 47 times the contract size of 100. $4,700 is my maximum loss. $4,700 is my maximum loss. You know, if somebody exercises the put, so an investor buys this 50 put. I sold the 50 put. The investor that bought the put, they exercised the put. They're going to sell the stock to me for $50 a share. As the seller of the put, I've got to buy the stock at $50 a share. The worst case scenario, the stock goes to zero. I lose $50 a share. I bought it for $50, stock goes to zero, I lose $50 a share. So I lose $5,000 in this case. Now, I did sell the option for a premium of 3 or 300. Therefore, that $300 that I took in will offset that $5,000 loss. So the maximum loss is $4,700. $4,700. So those are some examples of options as it relates to in the money, out of the money, at the money, parity, max gain, max loss, break even. One other thing I'd like to cover with you before we move away from our examples here, we're going to draw a box. And we're going to divide this box into 4 sections. Outside of the box on the left-hand side, we're going to see bullish. Outside of the box on the left-hand side, we're going to see bearish. Bullish will be on the top row. Bearish will be on the bottom row. Now, very top of the box, left-hand column, we're going to see hedge. Right-hand column, we're going to see income. So I've got this box broken into 4 quadrants. The top 2 quadrants are bullish. The bottom 2 quadrants are bearish. The left-hand column is to hedge. The right-hand column is to generate income. What could I do with options to hedge? I'm going to buy options to hedge. What could I do with options to generate income? I'm going to sell options to generate income. If I'm bullish and I want to hedge, I would buy a call. If I am bearish and I want to hedge, I'm going to buy a put. If I am bullish and I want to generate income, I'm going to sell a put. If I'm bearish and want to generate income, I'm going to sell a call. So the upper left-hand quadrant of the box says buy call. Lower left-hand quadrant says buy put. Upper right-hand quadrant says sell put. Bottom right-hand quadrant says sell call. So you see a question. You have a client who is bullish on ABC stock. What option strategies might you recommend? Well, buy a call if they want to hedge, or sell a put if they want to generate income. What if you see a question, a client is bearish and they want to generate income? What would they do? Sell a call. What if they want to hedge a position? What would they do? If they're bearish, they would buy a put. They would buy a put. So those are some examples of options relative to in the money, out of the money, at the money, max gain, max loss, break even, and strategies. What do we do to hedge if we're bullish? What do we do to hedge if we're bearish? What do we do to generate income if we're bullish? What do we do to generate income if we are bearish? All right, so that kind of takes care of the option positions. Now we need to talk about options as it relates to the administrative aspect of options, if you will. Option Clearing Corporation, the OCC, is the issuer of options. The Option Clearing Corporation, the OCC, is the issuer of options. They establish standardized features. They offer liquidity. So what are the standardized features as it relates to options? Again, these are established by the OCC. When do options trade? Monday through Friday, business days, from 9:30 a.m. to 4 p.m. Eastern Time. Monday through Friday, business days. If it's a holiday, they don't trade, but Monday through Friday, business days, 9:30 a.m. to 4 p.m. Eastern Time. If I were to buy an option, when would it settle? When would I have to pay for the trade? Trade date plus 1 business day is when option trades settle. So I would have to pay for the trade the next business day. So if I bought a call on Monday, when would I have to pay for that call? Tuesday. If I bought a put on Monday, when would I have to pay for that put? On Tuesday. If I sold a call on Thursday, when would I receive the money? On Friday. If I sold a put on Wednesday, when would I receive the money? On Thursday. Now, options expire. Options are issued for a maximum of 9 months, and at the end of that 9-month period, options will expire. Now, when do options expire? They expire on the third Friday of the month at 11:59 p.m. Eastern Time. Another standardized feature: when can I exercise my option? If I buy a call, when can I exercise that call? When I buy a put, when can I exercise that put? Options can be exercised anytime up until the expiration date. That's known as American style. That's an American style option. Anytime up to the expiration date. Now, if I do exercise my option, when would the trade settle? When would the trade settle? If I exercise a call and buy 100 shares of ABC stock, when would I have to pay for that stock? When would I receive that stock? When would this settle? That would be the same as any other security settlement, which is exercise day plus 2 business days. Index options settle in cash, not in securities. Foreign currency options settle in cash, not in securities. There are no securities to deliver with an index option or with a foreign currency option. What about assignments? What about assignments? I buy a call and I choose to exercise that call. Well, that exercise has got to be assigned to someone who sold the call. The OCC, the Option Clearing Corporation, will be notified and select the customer to exercise the position against. Now let's talk about the option disclosure document, which includes the option agreement. The option disclosure document, commonly known as the ODD, must be provided at or before account has been approved by the ROP. ROP stands for Registered Options Principal. Registered Option Principal. So I'm a registered representative. I've talked to a client or a prospect about option trading. They said, yes, I'd like to open up an option account and trade options. I've got to provide the ODD to the client at or before the account approval by the ROP. Now, this ODD is going to explain the various strategies regarding option trading, risk, rewards. This is going to be a document that provides full and fair disclosure as it relates to option trading. Now, in the option disclosure document, there is an option agreement. The customer must sign and return the agreement within 15 days of the account being approved. Now, they do not have to sign and return the agreement before the first option trading, before the first option trade. Trading begins with the account approval. So if I get the account approved by my ROP and I provide the ODD to the customer at or before that approval, I can go ahead and trade options for this customer for the next 15 days. They can buy options, they can sell options, they can exercise options, they can do whatever they would like during this 15-day period. Within that 15-day period, I've got to receive that signed agreement, basically acknowledging receipt of the option disclosure document and their understanding of strategies, risks, and rewards. What if I do not get the account agreement signed within 15 days of the account being approved, what's going to happen? Can the client continue to trade options? Yes, they can. Now, they will not be able to put on new option positions, but they could trade options by closing existing positions. So during this 15-day period, one of my clients bought an XYZ 55 call option. I did not get the option agreement returned within the 15 days required. Client calls me up and says, I want to buy a new option. I would not be able to sell them a new option, but they could close their existing position.